Dear all, thank you for visiting my channel. This is the first video that I'm posting online where I'm going to share my views on certain stocks that I have invested in over the past few years. My objective of starting this channel is to provide more information and factual data around the select companies, where they stand today, potential outlook, and my overall views around such companies. I hope to provide you more meaningful information and in an easily digestible format. Since this is my first video, your views will help us refine this presentation process going forward. So, the first company that we are going to cover is S. It is one of the oldest education companies in India. So if we look at the overall process, the way we are going to cover it is we are going to talk about the company, its key business segments, some of the initiatives taken by the company, how the company has performed over the past decade, where the company stands today, the key drivers for growth, the financial statements, and then the current valuations. So quickly now moving to slide number three. So if here we look at it, the company is, 80, I would say 84 years old as of today, one of the oldest education companies in India. And it has, it operates in three key business segments, which are K-12, higher education, and competition. So overall, in terms of the presence, the company is present across India, and at the same time, the bulk of its revenues, around two-thirds of the total revenue, comes from North and Eastern India markets. It has limited presence in South and Western India markets, but is there as of now. So I'll just quickly touch base on K-12 as of now. So moving to K-12. So basically, this is the segment which is the primary driver of company's growth and revenue. This accounts for 80% of total revenues of the company, and in this, the company offers textbooks and then related digital solutions to schools affiliated under various boards. So CBSE is the primary board, followed by state boards and ICSE. Overall, the company is catering to up to 25 million students as of today, across 40,000 odd schools. The number of schools covered by the company has come down over the past few years because the company is focused on improving the quality of sales that it does. But overall, if you look at it, the company has a market share of not more than 10% in terms of the overall private school coverage as it stands today. The company operates in a highly competitive space, but there are a few, factors that provide the company with a distinct advantage. So it has a combination of leading authors. It has well-established titles that have, basically been a key point of stickiness for people to stay with the company or with the publisher. And then it has a very strong distribution network as well. So overall, if you look at the company's revenue, if it earns 100 rupees of revenue, out of that 80 rupees comes from K-12 segment, and within that 80, 60 to 65% of the revenue comes from CBSE, which I think is also understandable because CBSE has a large presence in northern and eastern India markets as well. That is followed by state boards, which account for around 20 odd percent of companies' K-12 revenue, and then the remaining comes from ICIC board. One key point to note here is that the company made an acquisition of Chaya Prakashni in 2016, for 250 crores. And this allowed the company to establish presence in the West Bengal State Education Board market as well. So that's where we stand as of now for the K-12 segment. And then if you look at the higher education, so in this the company basically caters to students and institutions, targeting the college and university segment. So there are a number of courses that the company covers. This is a segment which has been very stable for the company. The company, has gets 15% of its revenue from this specific segment, and the segment has grown at around 9 to 10% over the 10 years. It has neither, it is expected to grow at the same rate going forward as well. So I think that's how we should look at it. Now I'll show you some, provide more color on the kind of titles that they offer, and and the kind of spread that they have. So they are covering more than 15 different segments within the higher education space. So if you look at higher academics, which includes colleges and universities, the company, provides titles in commerce, accountancy, biology, mathematics, chemistry, PCM as we may call it, economics, education, history, sociology, in all those areas. And within brackets, it just reflects the number of titles that it has. So within commerce per se and management, it has more than 220 titles, which is a pretty significant number. Then we can talk about the technical and professional education as well. So in this, if we look at it, the company is, providing titles specifically in the engineering space, and then a few in other areas as well. So this segment is also well covered by the company. Moving to competition. Now, competition basically includes, when students are preparing for competitive examinations or the entrance examinations. Now, that's also one segment that the company targets, although, its contribution remains at around 5% to the company's revenue. But this table should give sense around the kind of, examinations that it is catering to. So, for example, let's look at the bank examinations or civil services, or if we look at engineering, or state examination boards, it's covering all of those areas. So, so there are like a lot of state governments who open up vacancies for, filling up those vacancies. There are examinations that take place. So the company caters to that segment quite aggressively. So that is all about competitions. Then there is one segment called as early learning initiative. So before K-12, there's age group of 0 to 4 years. So that's one segment that the company has tried to capture in the past, but it has got mixed results. So, initiatives like Nuri Nori, the Play School segment, or Rice Kids, or Smart K, they have not performed well. The company has made a few digital investments in this space, specifically Smart ABT, and it has done well. And we will talk about it. But overall, if you look at it in terms of early learning initiatives, the company has negligible presence, and we do not look at it while valuing the company. So moving to the digital initiatives, since the traditional paperback, or hard textbook concept is waning away slowly, although still highly prevalent. The digital initiatives at the same time have enabled the company to enter a more sustainable business model going forward. So overall, the company has made a lot of investments in this space, and we'll talk about five key initiatives that the company has taken in this regard. So first, we talk about LearnFlix. So it's an affordable learning app targeting the next half billion. So when we look at say Byju's app, or such apps, they basically charge a lot of money, and offer courses in a highly interactive format to the students. So LearnFlix is really cheap relatively. So a course may be offered for 1 year for anywhere between 2 to 3,000 rupees, depending on the price that you're able to negotiate with them. And it provides you the book content, it provides you the chapters in detail, and allows you to cover that topic well. Overall, the company has tried to add a number of subjects to it, and overall it has over 300,000 downloads. I have not seen the company push this out very aggressively. I think that's one area where the company may be lacking, but it's a good product, targeting tier 2, tier 3 cities. And I believe it has a lot of potential, but I do not see the company pushing this hard enough. Then we look at Sultan Chand Academy. So this is a YouTube based platform that the company launched in 2021. It has over 100,000 subscribers, 930 plus views, videos, and 11 million views. So this is as of 31st March 2023. The company has achieved a monthly run rate of around 1 million views, And frankly, this platform has performed, or the traction here has been better than what the company had anticipated. It's overshooting that. And, the good part about this YouTube channel of Sultan Chand Academy is that it allows the company to generate a lot of stickiness. So students can look at these concepts online. They can buy the books, or in case they already have the books, they are trying to understand the concept. They can learn about that specific concept from a very well qualified teacher on SCHAN Academy platform online as well at no additional cost. So it tends to create a lot of stickiness around it. And because after say 8th standard onwards, you are able to choose books that you would like to study in addition to the books that form part of the curriculum. So it allows the company to target that specific segment as well. And I would suggest you to spend a few minutes reviewing the SCHAN Academy platform as well. It's quite good. Then we look at test coach. Again, it's basically catering to the competitive examination segment, wherein it covers over 100 national and government agency vacancy tests. It has had over 200,000 downloads, and is doing well for the company. After that, the company has two solutions catering to the school segment. So one is Madhuban Education 360. So this is a K-12 learning management system for schools to conduct online classes. This basically, really is something that saw a lot of traction at the time during COVID times. The online classes were enabled using this platform at a number of schools. It allowed the schools to assess the students. It provided ebook support. So overall, a platform which currently has over 100,000 students across 55 schools in India. Then the company launched, Milestone Curriculum Solutions. So this is a digitally enabled complete curriculum solution for K-8 schools. So in this, basically, the school very closely collaborate with, Milestone, which forms, part of the digital solution offered by the company, which is targeted more towards larger schools. So what happens in this basically is that it comprises of digital content. So you are able to see the books, you are able to review that in the form of rich animation online as well. In terms of digital content on the school boards, you have a milestone app wherein teachers, parents and students can engage. The teachers have their own notes or handbooks that can be incorporated into it, because every teacher has a unique way of teaching. And then the course books as well. So a good solution that has seen good traction over the past few years. Now we talk about the digital investments. So these are not the initiatives taken by the company, but the investments actually made by the company over the past few years. So Testbook Edu Solutions is a competitive exam preparation site in which the company invested 2.3 crores in 2015. The company was able to sell the entire stake last year in July for 17.9 crores. So good ROI, although the amount of capital invested is negligible, but still I think it is to give some sense around the kind of investments that the company has made. So Smartimedia is one of the good investments made by the company in the early learning solutions space. So this is kind of a DIY activity toys based on STEM learning concept. So in this, basically there are a lot of kits that are offered to the students, which helps them to, which basically leverages the STEM platform for students to learn more about STEM education, which is basic science, technology, engineering, and mathematics based concepts. So in this, the company invested 2 odd crores across 2 rounds of funding, and the company has around 16% stake. And as per the last capital raise round, the company's stake is valued at 15 odd crores. So it's already close to a 7.5x ROI for the company, and the company expects it to do well going forward as well. Then the company recently, sold its stake in iNeuron Techno Intelligence. Another online platform that offers affordable online courses in data sciences, AI, machine learning, and such areas. So these are some of the investments made and a couple of successful exits that the company has had. So overall, if you look at the last 10 years, if we look at the company, we'll try and split it into various phases, and I'll talk about it now. So the company, if you look at it where it stood in 2011, the company had a very strong brand recall. It's very well known, but the company witnessed moderate growth over the past 15 to 20 years. So if you look at the period of 90s or 2000 to 2010, the company's growth rate was never significant. It just grew at a moderate rate. But what happened over the next 6 years is that the company saw its revenue growing from 173 crores in financial year ending 12 to 790 odd crores in FY18. So that's a 30% CAGR that we are looking at over here over a 6 year duration, which is absolutely significant. A company with the 90, 80 plus years of background achieved a revenue of only 170 crores in that duration, which just increased significantly over the next 6 years. So this was basically aided by a number of acquisitions made by the company. So like Madhuban, Vikas Publishing, New Saraswati, Chaya Prakashni. So these are some of the key acquisitions that helped the company grow. But what happened as part of this rapid growth is that it just went, out of control for the company. So, but before I talk about it, let me show you the numbers around the growth phase. So, if you look at the revenue from operations in FY12, it was 173 crores, which reached close to 800 crores in FY18. During this time, the company's gross profit margin increased from 50 odd percent to as high as 68%, which is very good. But then at the same time, if you look at the employee expense also increased very rapidly at almost a CAGR of close to 40%, specifically 38%. And but the overall, due to increase in the gross margin, the company was able to see a healthy EBITDA margin of 24.3%, which was uh, if you look at it, 1,000 bips increase from 14.7% in FY12. So, in summary, a 173 odd crore revenue generating company with a 25 crore of EBITDA reached a EBITDA of close to 200 crores over a 6 year period, and its profitability jumped from 15 odd crores to over 100 crores over a 6 year period. So that's pretty fantastic. But this growth uh, and the performance that we are seeing in the annual statement actually did not result in the kind of result that the company anticipated. So if you look at it, this growth was accompanied by significant deterioration in the balance sheet. So if you look at the assets of the company, which stood at 200 odd crores, 217 odd crores in FY12, increased to 1500 plus crores in FY18. The debtor days, which were 150, doubled to more than 290. The net debt increased from 70 crores to close to 140 crores. Right. So what this, if you look at it, translates into is the fact that the growth in profitability is not accompanied by growth in the cash flows. So the challenges faced by the company started showing from FY18 onwards. So what happened with the significant growth is that the sales return reached a high level of up to 30%. So if the company was selling 100 rupee of books, 30 rupee worth of books were coming back to the company over the next 1 to 2 quarters. The distributors were not able to sell it. The company was pushing the books hard into the market, but that just resulted in a higher sales return. And what was the result? The company's revenue, which was 794 crores, came down to 520 crores in FY19. That's a 30% plus revenue decline, right? Which further declined in FY20, which coincided with COVID. So there is some attribution we can do over there, because before COVID, the company was targeting this to get closer to 600 crores. So that's fine. FY21 again, the company's revenue remained flat, and in FY22, the company has seen a 17 odd percent revenue growth. So the gross profit margin, while being maintained, we saw a significant decline in EBITDA margin happening. So why this happened? With decline in revenue, we were seeing the employee costs increase at the same time, and we saw other expenses also increase, which included some of the key cost expenses like returns. It included bad debt provisioning and all those aspects. So this really had a impact on EBITDA, which was at 192 193 crores in FY18, was a negative 31 crores in FY19. And it took company, you can say, another 2 years before it turned profitable at the EBITDA level. And then if you look at it in terms of the PAT came down from 100 crores to close to 8 crores in FY22. So that's not a kind of a performance that one would envisage. But we can say that the company, faced a lot of challenges. And the good point is that the company recognized those challenges and tried to take them upfront. So now moving to the next slide, we see that when the company started hitting the reset button in FY19, the balance sheet also started to improve slowly. So how do we see that? The number of debtor days which had reached 300 started to come down. So it came down to 222 last year, is expected to come down further this time. The inventory levels, which reached close to 40%, are down to 27%. And the net working capital days also have come down from 180 odd to 130 odd as of last year. The net debt, which was kind of a cause of concern because of poor cash flow generation, has also come down significantly from 180 plus crores to 83 crores as of financial year 22. So I would like to here just capture the summary of what we have just seen till now. The company it's established itself as a reputed brand in the education market in 2011. Then, aided by private equity investments, the company went on an acquisition spree and expanded its product portfolio during 2011 to 18 period. This growth phase led to increase in bad debts, higher than anticipated sales return, and higher inventory. This overall resulted in negative cash flow and excessive debt buildup in FY19. From FY20 onwards, the company focused on improving business and working capital performance by keeping growth on the back burner. So growth was not the priority now. The priority was to set the business right. So it has taken company around 3 years to turn around the business performance. And from FY23 onwards, the company is well placed to benefit from adoption of the new education policy 2020. Overall, when we talk about just as a quick reflection over here, when we talk of acquisitions over here, it is pertinent to note that the company spent close to 450 crores on acquisitions and 125 crores on digital businesses during the 6 year period starting FY12. And so that's the kind of volume of money that the company had spent at that point in time. Now, before I talk about the financials, I want to spend a couple of minutes on the new education policy that has come in. So the national education policy came in 2020. And the aim was to basically make education more holistic, flexible, and multidisciplinary. So the last education policy that came in was in 2005. So it's been now close to 18 years, and with change in the overall ecosystem, the curriculum also needs to be updated. So a kind of a pretty significant exercise has taken place over the last 2 to 3 years, where we consider old curriculum to be less relevant, and the new curriculum is expected to be quite disruptive in nature. So, for example, the 10 plus 2 structure of teaching that has, been followed for the past many decades is now likely to go out. And it is going to change in this format, where we are going to talk about, four stages: the foundational stage, which is the first stage, then the preparatory stage, middle, and secondary stage of education. So in this structure, we are talking about 5 plus 3 plus 3 plus 4 model. So this will replace the 10 plus 2 model. And so the foundational stage has already been announced in October 2022, and it has already been adopted in all the schools across India. It has been mandated by CBSE as of now. And then, if you look at the other three stages, they're expected to be announced in calendar year 2023. Now, the reason why this becomes very important, it's very important to understand that close to, 15 to 20% of the books that are being sold every year in the market or being used are the old books. Now, what happens over here is that with change in the curriculum, that market segment of 15 to 20% is going to become irrelevant, because the old books cannot then be used for the next calendar year. So what happens is that where the organic growth of the companies was around 8 to 12%, every year, now they are going to get, instead of a 80% pie, a 100% pie to themselves. So that's a 25% increase in the market size, and that is going to remain there for next few years before the new books that are being sold today become old and form part of the circulation process in the overall market. So that is kind of a kicker that is expected to come in going forward as well. So let's look at the current scenario now. Coming back to the company, the cash flow generation of the company has improved. There has been a strong control over the net working capital with strict credit policy, which has resulted in lower bad debts, lower sales return, and lesser level of inventory as well. This has resulted in freeing up of cash and positive cash flow generation. So if you look at it, while the company's revenue declined from 794 crores to 481 crores in FY22, the quality of customers that the company is dealing with has improved significantly. So, if you look at it, the company has, you know, reduced the number of distributors that it has, the number of schools that it is catering to, in order to ensure that it gets paid on time. The number of sales return are minimal, and they are able to maintain a tight operating structure of the overall business. So currently, where the company stands today, it is looking to achieve a revenue of around 640 crores in FY23. So from 481 crores in 22, they are looking to achieve a revenue of 640 crores in FY23. That's a pretty significant price. This will include a 20% increase in price and a volume growth of anywhere between 5 to 10%. That is tentatively the kind of range that the company is looking at. And just in case, as of today, if the NCF adoption does not take place in FY22, the company is still looking to grow at 10 to 12% per annum. So this includes, a price increase of 7 to 8%, and a volume growth, organic volume growth of 4 to 5%. So even if NCF does not take place in the current calendar year, we will still see the company growing anywhere between 10 to 12% for the foreseeable future. So here we are showing the profit and loss statement of the company for the past 6 years, and then a few years going forward. So if you look at it, what we believe is that the company is likely to achieve a PAT of around 55 odd crores in FY23, and this is going to increase to 86 crores in FY26. So we expect the company to see a good revenue growth of anywhere between 14 to 17% over the next 2 to 3 years. This number can, you must note that this number can be easily shot up, or let me rephrase it. This number uh, can be easily achieved in case NCF adoption happens this time, because the growth can then be anywhere between 20 to 30%. But we are trying to be a little bit more conservative in our estimates. So if you look at it, and assume a revenue growth of around 14 to 17% over the next 2 to 3 years, we see a marginal increase in gross profitability happening. The EBITDA margin seeing a marginal increase, because the employees have now become stable. We only see that increasing in line with the growth in business. The publication expenses are more or less stable in nature, and the other expenses are also expected to remain within check. With all those things staying in picture, we expect the company's PAT margin to remain stable around 9 odd percent, and the EPS to increase at the same time from 15 to 16 rupees in FY23 to close to 25 rupees in FY26. So this is how the common size, the cost structure actually looks like as of now. So please note here, what we have done is that we've included the cost of material with the publication expenses included in this, which had not happened in the P&L statement. So overall, if we see, the company is targeting close to 55% gross margin. So the 45% split comes in like this. We expect it to remain stable going forward. In this business, the companies generally have the the room to increase prices. The prices cannot be increased significantly, but the companies have room to increase the prices in order to maintain gross margins or to meet with the cost pressures that they face. And once the prices increase, until as you see a significant decline in costs taking place, or the paper cost, the prices would largely remain stable. Only under some segments would the prices come down. So so that kind of pricing power exists in the industry. And so coming back over here, if you look at it, the gross margins are expected to remain stable, with costs remaining around 45%, other expenses remaining around 15%. And then the only point here to be noted is that we look at the return on equity of the company, which we estimate to be around 7 odd percent as of now. And this will take some time to hit the double digit number, so maybe around 4 or 5 years. And this is one number which we believe in medium term to long term is critical, for, and is, will determine the kind of multiples that the company can trade at going forward. So we'll talk about it. And then moving to the balance sheet, it just quickly shows you the kind of balance sheet structure that the company is looking to have. So the overall asset base has been brought under control overall, and the best way to look at it is from the ratios perspective. So we expect the debtor days to now remain in the range of 190 to 200, which had shot up to close to 300 a few years back. And if you look at the net working capital days, we expect them to be around 129, 125, 130 days, and we expect it to remain stable. And the net debt for the company expects to become absolutely debt free by end of this quarter, which is fourth quarter of FY23. To be on the conservative side, we are saying the company will still have 50 to 60 odd crores of debt, and that is expected to be negligible, that the company can easily cater to, given the kind of cash flows that it is now generating. So now moving forward, this is the kind of cash flow statement that the company has had till now. I'll just, you can pause the slide over here and have a look at it to understand how the cash has been spent by the company over the past few years. Now moving to the valuations. So this is actually incorrect. The As of 10th April, I would say the stock was trading at close to 218 rupees. which is around 14 times FY23 P multiple. And if we look at the company in the medium term, there is high likelihood of the company trading in the range of 15 to 20 times 1 year forward P multiple. This range is basically coming on the back of, we believe, the positive sentiment that the space is, witnessing, and the sentiment is only going to improve going forward. uh, the improvement in the financials of the company that is taking place, and so overall, and the way the stocks have traded in the past historically. So if you look at it, assuming a FSX PAT of around 86 odd crores, we expect the company to trade anywhere between 12 to 22 times. So assuming this kind of range, you can see the kind of IRR that the company can generate, assuming that these multiples that you have taken are on a 1 year forward basis. So as of April 2025, if we take the March 26 PAT of 86 crores, assume a conservative multiple of 12 times, as of today, where we are standing, we can generate a IRR of around 16 odd percent, and which is over a period of 24 months to be more specific. And if the sentiment remains good, then we can look at generating a IRR of anywhere between 30 to 50%. But in long term, we do not expect the company to trade at such multiples unless the ROE shows significant improvement. I think that's one of the key factors to look at as well. This is the historical, trailing 12-month P multiple chart of the company. So this is where the company listed. It had a trading multiple of over 30x, which came down to around 10 times before the company's PAT went negative. And currently, if you look at it on a trailing basis, the company is trading at a multiple of around 10 times. So with improvement performance, we believe it should be somewhere around 15 times, 10 to 15 times. And I think that's the kind of range we should look at. And in terms of where it is trading, you can form your own view in terms of where the stock can be. In terms of my own purchase, I purchased the stock in the price range of between 56 to rupees 58. So it's close to a four bagger for me as of today. I believe with improvement performance, the stock can get to anywhere between 300 to 400 rupees over the next 2 years. Whether it gets there or not is anybody's guess. But given where we are today, I would like to hold on to the stock for another 12 months before deciding whether to stay invested or to liquidate the position. I think we'll wait for the completed option of NCF in case that happens during this calendar year, and see how that impacts the performance of the company before we decide whether we liquidate or not. So I think that basically is a summary of where we look at it. In terms of views on the management, the promoters have been in the industry for a very long time. They are passionate about the space, and they like to stay focused on the business. The company did lose its way when it started to grow at a rapid pace. It was more than what they could chew. But I think the credit should go to the management. They saw the challenges and decided to meet them upfront, and take the corrective course of action. So they have spent last 36 odd months correcting the course, putting the right systems, processes in place. And in terms of the quality of business, I believe the business overall is much better placed today than where it was, or the way it was a few years back. And you know, I think that's it from my end as of now in this regard. And these are some of the disclosures. I believe it's very important for me to highlight that, while I'm holding this position today, in order to make this interaction more meaningful, we would suggest you to take more contrarian views and try and see where our views are not holding solid ground, and how we can improve the process forward. Please do not use our interactions as a means of making an investment decision. We are, sharing these slides as part of, knowledge development, as part of making ourselves better, and sharing more information with you about those specific companies. And we would suggest you to take an opposing view and make comments in order to make the overall information exchange more meaningful. I hope you have learned a little bit about the company using this time of yours, and we look forward to again sharing more views with you going forward on some of the stocks in coming weeks. Thank you so much for your time.